Hello, and thank you for joining us for this program presented by the Wharton School's Jacobs Levy Equity Management Center for Quantitative Financial Research. I'm Chris Geczy, Academic Director of the Jacobs Levy Center, and it's my pleasure to host this presentation. The Jacobs Levy Center was established through a generous gift from Wharton alumni Bruce Jacobs and Ken Levy in honor of the 25th anniversary of their firm, Jacobs Levy Equity Management. Its mission is to leverage the research strengths of the Wharton School to increase understanding, or as we might say, move the needle, over the theoretical and practical aspects of quantitative finance. As many of you already know, we host conferences and gatherings, award the Wharton Jacobs Levy Prize for Quantitative Financial Innovation, which last year was awarded to Bill Sharp for his work on style analysis, and which this year will be awarded posthumously to our friend Steve Ross in the fall. And we support faculty and student research. As part of those efforts, we award the Jacobs Levy Center Research Paper Prizes annually to recognize exemplary submissions to our working paper series. The subject of today's presentation, Commodity Trade and Carry Trade, A Tale of Two Countries, is the recipient of our 2016 prize for Best Paper. I would like to extend my congratulations to the authors Nikolai Roussanov of Wharton, Robert Reddy of the University of Rochester, and Colin Ward of the University of Minnesota. Professor Roussanov is with us to present today an overview of the paper, along with Wharton alumnus Mikhail Samonov, who will follow with a discussion of the material. Both today's speakers have pre-recorded their presentations and will join us live for questions at the end. I encourage you to submit questions at any point during the program. We would like for this session to be innovative, interactive, and will address as many of your questions as possible. I am pleased first to introduce Nikolai Roussanov. He's the Moisa Wysafra Associate Professor of Finance here at the Wharton School, as well as a research associate at the National Bureau of Economic Research, or NBER, or just the Bureau. He holds an undergraduate degree in mathematics from Harvard College and a PhD in finance from the University of Chicago. Nick's articles have been published in journals including the Review of Financial Studies and the Journal of Finance, and he was the recipient of the 2015 AQR Insight Award. He currently serves on the board of directors of the Macro Finance Society and on editorial boards at the Journal of Finance and the Journal of Monetary Economics. His research focuses on areas of interaction between asset pricing and macroeconomics, ranging from equity to fixed income currency and commodity markets, and also to entrepreneurship and consumer financial behavior.
Thank you, Chris, for the introduction and invitation. It's my pleasure to be here to talk about my work on commodity trade and the carry trade. This is work joint with Rob Reddy and Colin Ward, who are both graduates of the Wharton School PhD program in finance. So, currency carry trade is one of the most well-known trading strategies in the global macro space. Now, the academic research on this topic goes all the way back to the early 80s in the work of Lars Hansen and Eugene Fama, which was cited in their Nobel Prize in 2013. At the root of the carry trade is the fact that forward rates are not good predictors, are not unbiased predictors of spot rates. And foreign exchange markets, similar facts, in fact, hold for fixed income markets, and that goes back also to the work of Gene Fama and Bob Shiller. Now, these academics disagree about the causes of this sort of failure of the unbiasedness of the forward rates, whether it's risk premia, whether it's driven by kind of behavioral forces. But fundamentally, from the investor standpoint, the implication is that carry, or the difference between a forward and spot rate in the forward market, or equivalently interest rate differential, is a good forecast of future expected returns. In the foreign exchange market, this is known as a failure of the uncovered interest parity hypothesis. It says that high interest rate currencies do not depreciate over time, and low interest rate currencies don't appreciate over time. As a result, going long high interest rate currency and borrowing in a low interest rate currency delivers investors an average return. In a prior work with Adrian Verlan and Hanno Lustig, we argue that this carry trade risk premium can be explained by heterogeneous exposures to a global source of risk and heterogeneous exposures across countries, so that high interest rate currencies are more exposed to the global risk, whereas low interest rate currencies are less exposed to the source of risk. What we also show is that this heterogeneity is persistent, so that historically high interest rate currencies are the ones that tend to, on average, earn a positive risk premium, and historically low interest rate currencies tend to, on average, earn a negative carry trade risk premium. But we do not provide in that work an explanation or kind of the economic foundations for this heterogeneity. In this paper, we provide such an economic story for where this persistent heterogeneity is coming from. And it goes back to the observation that high interest rate countries tend to be commodity producing countries, and low interest rate countries tend to be producers of manufactured complex consumption goods. In this table, I have the basic summary of the key facts that our paper is about. In the first column, we have the interest rate differentials on a country vis-a-vis the US. In the second column are returns in dollars to an investor going long into that currency. And we see that countries like Japan and Switzerland on average have negative interest rate differentials, and investing in those currencies delivers an average and negative excess return. Conversely, the investment currencies of the carry trade are predominantly the commodity countries like Australia, New Zealand, Norway, and those countries have positive interest rate differentials, and investing in those countries delivers a positive average excess return. In the last column of this table, I have the variable we refer to as the import ratio. And this variable measures to what extent the country is a net importer of complex manufactured goods and net exporter of commodities. So this variable is negative for the complex good producers like Japan and Germany, and is positive for the commodity countries. So our story is really about how the first two columns connect with this third one, the import ratio. And we build a model to investigate what is the mechanism connecting these, and this is our tale of two countries that our model tells. It's, of course, a stylized model, but we think it captures an important piece of what is going on in the data. So in the model, we have two countries. One we call the commodity country, and the other is the producer country, meaning it's the country that produces the complex manufactured goods. Now, the producer country can only produce these final consumable goods, but producing them requires a basic commodity input. Think of, for example, iron ore that is required to make cars. The commodity country is the country that produces this basic commodity, such as iron ore, but it can also produce the final complex manufactured goods, although it is not as good at doing so as the producer country is. That is kind of our key assumption, that the countries are specialized to some degree in what they produce. Now, basically, the idea is that the commodity country will produce, using some local resources, the commodity, iron ore, and it will decide how much of it to use domestically in domestic production and how much to export to the producer country. Now, this gives potentially a sense of this Dutch disease phenomenon, where the commodity country may shift resources from producing the final consumption good domestically to producing the commodity that is then exported to the producer country. Although there is nothing bad or pernicious about this Dutch disease in our model. In fact, this happens when the producer country is very productive, very good at producing the final good, which it on average is, and in fact always is more productive than the commodity country at doing so. Now, in the absence of frictions in trade or transportation costs or any other trade costs, the countries would specialize perfectly. So the producer country would produce all of the consumable goods, let's say cars, and the commodity country would perfectly specialize in producing the iron ore that is required as an input for doing so. But we assume that there are frictions in transportation and other potential costs to trading, congestion in ports, the limitations in shipping capacity that prevent that perfect segmentation. In fact, we assume that the costs of trade rise as the amount of trade increases, which happens when the producer country becomes particularly productive sort of during global economic and trade booms. What this means is that the countries will be differentially exposed to the productivity shocks that drive the global business cycle. And these are the shocks that occur in the more productive country, the producer country. Now, a natural kind of implication of this model is that the exchange rate between the two countries is determined by the relative productivities of their manufacturing sectors, because they determine the price of the commodity in the two countries. So when the global price of the commodity is high, the commodity currency appreciates, and when the global price of the commodity is low, when a global downturn is generated by the declining productivity in the producer country, the currency of the commodity producer declines. Now, what is the implication of this mechanism? Well, in global booms, the times when the producer country is very productive at producing the final good, consumption increases faster in the producer country than in the commodity country, because trade costs rise with trade as, again, port congestion worsens, the shipping capacity is slow to adjust. And so the producer country absorbs that excess output or in greater consumption. But the flip side of this mechanism is that in bad times, when productivity in the producer country falls, the producer country's consumption also absorbs this decline. This is not only because the trade costs fall in this global recession, but also because the commodity country can now smooth the shock by shifting resources domestically from producing the commodity, which is now less valuable globally, to producing the final consumable good, and therefore insulating itself from the global productivity shocks. As a result of this, the consumption of the producer country is going to be more volatile than consumption of the commodity producing country. So consumers in the producer country are going to demand a greater precautionary cushion and save more, pushing down the domestic interest rates, whereas this effect will be much weaker in the commodity country where consumption is less volatile. So the interest rate differential will be positive, whereby the commodity country has on average a higher interest rate than the producer country because of this difference in precautionary saving demand. Now, at the same time, the producer country consumer will also demand a risk premium for investing in the commodity currency, because the commodity currency is risky. It goes up in good times and it falls in bad times. So this differential in interest rates caused by the difference in precautionary saving demands will translate into a currency risk premium, not a depreciation of the commodity currency on average. And thus we have a carry trade. A positive interest rate differential is translated into a currency risk premium. In the rest of the paper, we verified that this mechanism is indeed strongly supported by the data. We begin with the trade data from the United Nations and form this import ratio that I mentioned earlier, which measures to what degree the country is a net importer of finished manufactured goods and exporter of commodities. And we show that this import ratio very strongly across a larger cross-section of countries that I showed earlier predicts differences in interest rates on average, as well as average currency returns from the perspective of the dollar investor. In fact, we show that forming portfolios based on the import ratio produces the same magnitude of the carry trade risk premium as sorts that are based on the carry or interest rate differential itself, which are more common in the literature. Further, we show that, in fact, the mechanism of our model that links currency fluctuations and currency risk premium with trade costs and commodity prices are also consistent with the data. And in particular, during the global financial crisis, we saw a very sharp depreciation of the commodity currencies, appreciation of the producer country currencies, such as the Japanese yen, for example, as well as a sharp fall in commodity prices and trade costs as measured, for example, by the Baltic Dry Index of shipping costs. Now, we can show that, in fact, you can enhance the profitability of carry trade strategies by conditioning them on either commodity prices or shipping costs, which captures this the kind of idea in the model that the magnitude of the carry trade risk premium is dependent on the state of the global business cycle. Finally, the key point of our model mechanism is that the producer country is riskier in terms of its domestic consumption than the commodity country. We saw this again during the global financial crisis, where labor productivity dropped much more sharply in these producer countries relative to the commodity producers. We also saw this in actual consumption, household consumption data, where, with the exception of Switzerland and New Zealand, the producer countries experienced much more pronounced drop in consumption than did the commodity countries. Similar evidence shows up in a larger cross-section of countries when we look at the stock market exposures to kind of global GDP growth, or countries' GDP growth exposures to the global GDP growth. And in this graph, I show this as a function of the import ratio. Now, our mechanism in the model says that the exchange rates are closely linked to these relative productivity wedges in the production of final consumable goods. This is sometimes kind of seen as a very kind of hard to find piece of evidence in the data. Currencies typically are thought of as being very unrelated to fundamentals. We show that actually for the countries that we're talking about in our paper, these commodity producers versus producers of complex manufactured goods, we see a very close connection between relative productivity differentials and real exchange rates. And this is true for pairs such as Australia and Japan, or Canada versus Germany, or Germany and Japan, or Norway versus, say, Germany, Japan, and Sweden. Similarly, we see that relative interest rate, real interest rate differentials are also quite closely related to relative productivity, as our model predicts, also kind of in this set of countries that we're talking about. So just to summarize briefly, our paper proposes an economic mechanism that relates commodity trade to the currency carry trade. So again, the idea is that commodity currencies are risky because they rise in good times when global business cycle is booming, and they fall potentially sharply in global economic downturns. Because they're risky, they earn a risk premium, potentially quite rationally. Now, these countries, commodity-producing countries, also have higher interest rates relative to the producer countries, because their domestic consumption is less exposed to global shocks, and therefore there's a kind of lower demand for precautionary saving. Thus, higher interest rate differentials translate into higher currency risk premium, not depreciation of high interest rate currencies on average. We show that basically you can capture the entirety of the sort of slow-moving component of the carry trade by measuring this degree to which a country is a producer of complex manufactured goods, and therefore being of a low interest rate, low risk premium country and currency, versus being a producer of basic commodities and therefore high risk premium and high interest rate currency. We also show that this risk premium associated with the commodity currencies, high interest rate commodity currencies, is pro-cyclical as captured by the measures of the global business cycle, such as commodity prices and global trade costs or shipping costs. This is a very brief summary of this research, and I look forward to discussing this more with you, and I'm looking forward to Mikhail's comments on our work. Thank you very much.
Nick, thank you very much. It's now my pleasure to introduce Mikhail Samonov, who will present a discussion of the paper. Mikhail is a senior portfolio manager at Forefront Analytics and an alumnus of the Wharton MBA program. He also holds a bachelor's degree in applied mathematics and economics from Brown. In his role at Forefront, Mikhail is responsible for managing multi-asset and alternative portfolios, as well as ESG and impact investment strategies. He also manages a team of researchers developing quantitative, factor-based investment strategies. Mikhail works closely with me at Forefront and as a teaching associate for my investments and impact investing courses here at Wharton, and he's actively involved with me in academic research on factor-based investing, as well as impact investing and behavioral finance. Mikhail?
Good afternoon. Thank you for joining us. Thank you, Nick, for an outstanding paper and for your great presentation of your work. And thank you, Chris Geczy, for the introduction and for having me here as your discussant. Thank you, Jacobs Levy Center at the Wharton School here for hosting this webinar. Today, we're here to discuss very important work about the nature and the risks embedded in the carry strategy, in the carry trade, as it is known in the industry. What the new insights from Nick's paper show us is that carry trade is actually potentially associated with commodity exporting activities of countries. Carry trade is a very popular investment technique, widely applied both intentionally in many hedge fund portfolios and multi-currency portfolios, as well as, I would say, unintentionally lurking behind the scenes in many fixed income portfolios and global asset allocation mandates. This is important, and this work highlights some of the potential drivers, risk factors, and expected returns of the strategy as a function of the commodity exposure of countries whose currencies the carry trade invests in. So more specifically, the insights of the paper observe the following relationship. There are permanent differences in interest rates between countries that seem to drive a vast portion of the carry trade profitability. And those interest rates are higher for commodity exporting countries on average than for the commodity importing countries. Another thing that is in common for commodity exporting countries is that their currencies are actually riskier. They're more correlated with the global production shocks. Combining the two effects together, we have the riskier currencies of commodity producers that should be earning a risk premium, and those countries have higher interest rates, allowing the carry trade portfolios to be profitable, or at least invest in the higher yield. The authors claim that they can explain about half of the carry effect using just the commodity export ratio for countries to capture this effect. The theoretical model that drives this prediction and the empirical results is based on the fact that commodity exporting countries can shift their production function from producing commodities to producing final goods, while the final good producing country can only focus on producing final goods. As a result of this specialization that's driven by productivity differences and trading costs, shipping costs in the middle, as a result of it, during the times of economic recessions and productivity shocks driven by the developed world, the commodity exporting country can shift its production from commodities to the final good production, hence insulating its economy from the production shocks. The paper builds a theoretical model that links then this less dependence of the commodity exporter on the global growth rates, and as a result, the precautionary saving rates in those countries are lower, driving the interest rates higher. That leads to those sort of permanent differences in interest rates for commodity exporting countries. At the same time, the authors observed that the currencies of those commodity exporting countries are actually highly sensitive, extra sensitive to the global production shocks. hence deserving a risk premium, a reward for taking that risk premium. Putting the two things together again, authors observe that you can capture most of the carry trade premium using, or at least half of the carry trade premium using this commodity export-import ratio to sort countries into high export countries and low export countries. Creating the long-short portfolios captures half of the carry trade spread. So the paper is quite fascinating, and we wanted to first test some of the paper's predictions on longer data. My co-author, Professor Geczy, and I are big fans of taking known ideas or kind of hypotheses and testing them out of sample on data all the way back to 1800, if we can. So what we did here is we took a couple of the predictions from Nick's paper and we tested them all the way back to 1800. The first prediction that we wanted to test is that currencies that are sensitive to commodities have higher interest rates. It's a very strong prediction. Now, what we didn't have is the paper's data, the macroeconomic data that we could use to build the sorts and to measure the commodity export ratio. So we went to the financial markets and we took the currency spot rates for the countries in our sample, which is 48 countries, 48 currencies, and we regressed them in a rolling fashion on the commodity price index that we constructed from the underlying 76 commodity spot rates. So that regression gives us a sensitivity of every currency in our sample to the commodity price changes. And the prediction of the model would suggest that the higher sensitive countries should have higher yields and lower sensitive countries should have lower yields. And so as a result, we break up our sample into two groups at every month in our sample, and we measure the average interest rate in each group, and we plot it over time. And this is on the next slide. So, of course, the paper covers data that on this graph would be on the very right side of the graph, the last 30-some years. And here, indeed, you do see, even in this definition of sensitivity to commodities, that the blue line is above the green line most of the time in the last 30 years, which is the sample of this work. Interestingly, if you start looking back through centuries, you observe that most of the time the blue line continues to stay above the green line. Hence, the yields of more sensitive countries to commodities persist to stay higher than the less sensitive ones. Now, you also see some periods where the two lines are close to each other and there's no difference. And then there are some short periods where the lines flip and the green line is above the blue line. So those periods especially are short, but they are definitely go against the prediction of the model. So perhaps they're worth taking a deeper look. But on average, we would say the prediction definitely holds up here. The average yield difference per year is around 55 basis points, with a t-statistic of above 8 over the entire sample. And I also computed the difference remains at 55 basis points even if you cut off the last 30 years. So purely out of sample with respect to this paper, the yield differential persists at 55 basis points. So that's a truly fascinating prediction, and it seems to hold up in this crude attempt to capture it for the longer data. The other prediction is much more rudimentary and basic, and it's really about the nature of the carry trade itself. We use the same data to actually construct the long-short carry portfolios all the way back to 1800 based on the prevailing interest rates in those countries, the short-term rates, and we computed the returns to the strategy. This is unpublished work yet, but it's based on Chris's and I work in 2014, again taking price momentum all the way back to 1800. So what we see here is the long-short cumulative log-scale return to the carry factor. The last 30 years here again, we overlaid Nick's data from his 2011 paper, the high minus low carry portfolios. And you see our blue line there. They're pretty similar over the overlapping period. And you can see a major bull market to that sort of investing strategy, huge returns. However, even a naked eye can see here, throughout the century, the carry trade experiences some really major drawdowns. Perhaps really the inherent risks that are part of the strategy start to show up only when you zoom out. And that's why Chris and I are such big fans of long-run backtesting of these sort of anomalies or risk premia, because these new episodes tend to really show up over longer time frames, as we saw with momentum as well. And perhaps more than any other risk premia, carry trade is the one closest associated with the concepts of insurance risk, and hence big crashes once in a while. And that's the true risk you might be getting compensated for, in addition to the other risks. And so here you can see drawdowns between 40% and 80%, depending on history, and those episodes tend to correlate with things like World War I and World War II. So again, this just gives us a quick snapshot of the history of the strategy. It's not meant to be a definitive answer of how carry trade actually looked like. There's a lot of assumptions and approximations, data-driven mainly. However, we do think this is a representative pattern of behavior of this type of strategy. And so the conclusion is sort of, while on the one hand, yes, it worked recently, and overall it does end up with positive premia. However, if we cut the sample 30 years ago, we would probably conclude that this is a very risky strategy, and it's not really potentially even worth taking that risk. In any case, it's something to continue studying, and we would encourage the authors of this great paper to look at longer time frames for the prediction, to test the predictions of their model in the paper. The couple other questions that I'd like to address are the first one about the shipping costs and the trading costs. Specifically, there's an implicit argument in the paper that somehow because the shipping costs are pro-cyclical, they actually negatively impact the variability of the commodity importer vis-a-vis commodity exporter. And to us, the intuition should be tested better, we think, and it potentially actually might work in the opposite direction. Because the trading costs are pro-cyclical, they would be lower in recessions, in productivity shock states of the world, hence making shipment of the final goods cheaper back to the commodity exporting world, hence actually cushioning the production function of the final good producing countries. So this is a question slash suggestion for more empirical tests there. The second comment about trading costs is their assumption or prediction, I guess, in the paper that the variation in the shipping costs only for the final goods varies with the business cycle, but not for the raw commodities. There must be tons of data out there. It would be great to validate that assumption and prediction if that can be done. Couple other questions. One is concerning the interest rates and what sets the interest rate differentials across countries. The authors presume and suggest that precautionary saving demand is the main and only really driver in this paper of interest rates. Of course, as Nick pointed out to me in our casual discussion, growth rates should be considered as well as a potential factor. The one we also want to add is the credit risk that's embedded in the interest rates, especially the time-varying default risks of various countries would have a really big impact on their interest rates. As we could see in the carry strategy returns that we just saw, potentially some of those drawdowns are indeed default risk driven, if you think about World War II and countries like Germany, etc. And finally, monetary policy, debt levels, access to global financial markets and liquidity also could be tested as potential additional factors, especially as they relate to the commodity exporting activity of countries, because there could be that missing factor there that's common between both interest rates and commodity exposures. And finally, especially the earlier versions of the paper, but the later one as well, has this logic that the consumption variability will be different between commodity exporters versus importers. First time I read that felt a bit counterintuitive. You would think emerging markets should have higher consumption variability, and they export a lot of commodities versus the developed markets. However, the authors do say that when you do such comparisons, everything else should be equal. So they take developed countries and compare them to each other and separate them based on the commodity exporting activity. And they do find some empirical evidence on the recent data of consumption variability differences. We would suggest to look at things like within emerging markets, does the same separation occur? And how about emerging market versus developed markets? And holding everything else equal becomes difficult in that condition. And of course, we would suggest looking at longer term data if it's available to continue testing this prediction. So overall, we were very, very impressed by this paper, great insights connecting carry trade to the commodity exposure of countries and commodity production of countries. And we believe it has significant implications for both investors using this strategy or measuring this risk and academics alike. Thank you very much, and now we welcome questions.
Thank you, Mikhail. We would now like to open up the session for questions from anyone who's in the viewing audience. I'd like to get things started. First, Nick, I'd like to ask you, since your paper puts into focus the essential relationship among exchange rates, local interest rates, and the profitability and risk characteristics of currency carry trade, which, as Mikhail nicely said, is really a big area. It's a big area of your research, but also incredibly important for industry and has been part of the secrets of the buy side in many ways for years, and now is finally seeing the strong light of academics. Does the evolving research, from your perspective, indicate implications for policy or for potential ways that traders could increase profits or reduce risk?
Thank you very much, Chris, and of course, thank you to Mikhail for the great discussion of our work, and I'm very pleased with the out-of-sample exercise that works out so nicely. As for the question, Chris, well, there are of course multiple potential implications of both our research and the research that has been done recently. This has become kind of a burgeoning field of or trying to understand the risk premia or sources of expected return in currency markets. As far as our research indicates, what investors might be cognizant of is that, expected returns are compensation for risk, and most standard ways of thinking about finance. Well, in our model, in our evidence, we show that carry trade profits are, to a large extent, compensation for bearing global business cycle risk that is also represented in commodity markets. So one thing that potentially important for investors to recognize is that since commodities have become such a popular asset class of its own recently, the risks in the commodity investments are not necessarily separate from risks that are present in other asset classes. And you might be loading on a commodity risk if you're doing carry trade strategies in the FX portion of your portfolio, and you should adequately manage the risk of the combined portfolio and potentially realize that there's the same risk exposures in different sides of that. And I think that is perhaps the most important sort of risk management lesson for portfolio management from our research. Of course, there is implications of better harvesting of risk premia that our research provides. As for the policy angle, obviously our paper is not about sort of macroeconomic implications, and I want to go too far on a limb on policy, but our model highlights the role of trade barriers in driving both sharing of risks across countries, fluctuations in exchange rates, and risk premia earned in currency markets. And in fact, in our model, the reason there is a risk premium to be earned in the carry trade is because there's segmentation in markets and trade barriers. So one has to be cognizant that the lowering or increasing those trade barriers is going to have consequences for foreign exchange markets and also risk premia earned by investors.
So this notion of shocks, sort of macro shocks, might ultimately be connected to sort of classical ideas of shocks to growth, sort of Chenroll and Ross kinds of ideas. Do you see this being a direct connect to our understanding emerging market risks better? You know, when you look in practice, but also in academia, emerging markets somehow get relegated to their own category and are sort of commingled in their risks. Is this a lens?
Absolutely, Chris. It's a very good question. So in our paper, we do not explicitly consider emerging markets, in part because we want to be very clear that this phenomenon of commodity-driven carry trade in the FX markets is not driven by emerging market currencies. This is actually something that is present within the group of the most liquid developed country currencies. So when we're thinking of commodity countries, we're thinking about Australia, New Zealand, and Norway. But that is not to say that a similar exposure to commodity prices is not present in currencies of emerging countries that are commodity producers. To some extent, it's an even greater kind of connection between those countries' exchange rates and their economies to fluctuations in global commodity markets, and therefore their exposures to the global business cycle risk. Something that, of course, will not be true for these countries is that they're somehow insulated from the global macroeconomic shocks. Quite the contrary, because they're developing, they're not fully integrated in the global financial markets. They're not kind of sharing risks perfectly with the kind of developed country consumers, and their manufacturing sectors are oftentimes underdeveloped or not developed sufficiently to kind of substitute domestically for production when kind of global productivity declines. Those countries are actually especially sensitive to global macroeconomic shocks, global productivity, global growth shocks, and so on. So you should certainly not think about them as something kind of secondary and separate, especially when you're thinking about investment in emerging market currencies or emerging market bonds. They're very much exposed to the global macroeconomic fluctuations and the same sources of risk that show up in most kind of global macro portfolios.
And it seems they also may have an organic levels and second moment or higher moment exposure to currencies, volatility, and certainly commodities.
Yes, absolutely. Absolutely. And I think, we don't go very much in our own research in this paper, but certainly there are all of these exposures and higher moments of those emerging market currencies and commodity markets.
Excellent. Well, thank you again for your presentation today. Mikhail, thank you as well. Maybe in the last couple seconds of the presentation or our time today, let me ask you what's next in this line of research that you've been pursuing for the last few years.
Well, there are lots of unanswered interesting questions in this field of currency markets, and to the extent that our paper connects it to commodity markets, also focusing on, again, the carry trade, something that I've worked on for now a long time with several sets of co-authors. Something that we don't quite fully understand yet as sort of academic profession is the role that the U.S. dollar plays in kind of not just the global monetary system and global financial markets, but also in driving carry trade profits. So what I've showed in an earlier paper with Hanna Lustig and Adrian Verlan is that the U.S. dollar seems to have this special role that you can generate very high Sharpe ratios by doing the carry trades vis-a-vis other developed countries from the standpoint of the U.S. and just going long, short, whichever one has a higher interest rate, whether it's the average kind of developed country or the U.S. dollar. And this is a very simple carry trade to implement, and this is a very different carry trade from the one that we're discussing in this paper that has to do with this very slow-moving or very persistent, almost permanent differences between countries and what they produce. This is just the U.S. dollar, and this, of course, the ranking of where the U.S. dollar interest rate is vis-a-vis other countries changes over the business cycle, and we're kind of going through a period of time where there is going to be potentially pretty drastic change relative to what we've been experiencing for the last few years, where that interest rate is going to be and what that is going to imply for carry trade profits, but also, of course, for the global macroeconomy and financial markets. And this is, I think, a very important area of research that is yet kind of to find its bright answers.
Excellent. Well, we're looking forward to it. Folks, you can check out Nikolai's paper by looking at the Jacobs Levy Center website and examining our working paper series. As with all good things that come to an end, we reach the close of our program, and I'd like to extend my profound thanks to our speakers, Nikolai Roussanov and Mikhail Samonov, for sharing their research and insights. Again, to learn more about the paper discussed here, as well as other research supported by the Center, I encourage you to visit our website. If you have any questions for the authors, you can, of course, email them directly. Again, congratulations on winning the prize. And folks, thank you so much for joining us this afternoon. Stay tuned for more, and we appreciate your time.
Thank you very much, Chris, and thanks to everyone.
Cheers.